Ah, my friends, gather round the virtual campfire. Today, let's talk about the fine art of turning ordinary economic policy failures into spectacular crises. You see, every day the headlines serve us another story about inflation, debt, and sluggish recovery as if it's some kind of global drama with no end in sight. In this episode, we'll dig into how businesses and households across the world's major economies are caught in a tangled web of precarious growth, political instability, and you guessed it, bad governance. Buckle up, because what looks like just another dive in business confidence is actually a tragic orchestrated play of misguided leadership. So, we're standing here in 2024, looking at the shambles of the global economy, and we must ask ourselves, how did we get here? Remember, inflation once soared to such heights that people started thinking owning a wheelbarrow was essential, not for work, of course, but for carting their money to the store as prices blew up like a balloon. Now, global inflation may have slightly cooled down, but here's the rub, businesses and households are still stuck in a rut. Even though indicators of real economic activity in powerhouses like the US and China have inched upward, the thing we rely on most, confidence, has plummeted faster than a poorly planned fiscal budget. You see, my friends, it's not just about the numbers on a chart. Economic growth doesn't mean much if everyone from corporate boardrooms to kitchen tables is gripped with gloom. The Brookings FT Tracking Index for Global Economic Recovery, TIGER, paints us a dismal picture. As of its latest update, confidence indicators across the globe, whether in well-performing regions or those floundering, are plunging like a stone in the ocean. Now, why is confidence so low, you ask? Surely, those in high places know their stuff, right? Enter stage left, political uncertainty. Because what's the best recipe for a failing economy, if not making sure nobody knows which policy's coming around the corner? And who better to disrupt any economic recovery than good old politics? Let's talk about the looming US presidential election. Oh yes, that theater of choose your own adventure we'll witness in November. Businesses, as it turns out, aren't keen to invest when they don't know if the rules will be rewritten next month. Could it be higher taxes? Tariffs? Immigration crackdowns? No one knows, and when no one knows, the economy falters. This political uncertainty doesn't end there. From the Middle East conflict to Russia's overheating aggression in Ukraine, the world is positively brimming with geopolitical instability. And oh, the irony, just when you think these are gone concerns, they resurface like unwanted party guests. Markets don't like war, destruction, or the unpredictability they breed, unless, of course, you're in the arms trade, but that's another conversation. In the words of Ishwar Prasad, senior fellow at the Brookings Institution, there is this sense of gloom and uncertainty, you think? It's almost as if when leaders prioritize conflicts and political squabbles over stable policy making, the economy experiences rippling effects. Imagine that. Now let's turn our attention to the IMF, which is in no better mood either. Kristalina Georgieva, managing director, called the current situation an unforgiving combination of low growth and high debt, like that strange couple you avoid at gatherings. But here we are, stuck with them, sipping inflation-flavored economic cocktails. The IMF sees troubled waters ahead, with some forecasts suggesting lukewarm growth, just 3.2% in 2024 and maybe 3.3% in 2025. Compare that to pre-pandemic norms and, surprise, surprise asterisk asterisk, we're scraping the barrel. Georgieva continues to hammer home the point that governments need to tackle their public finances, but with bloated debt levels and hostile political landscapes, is anybody really listening? Or more importantly, doing anything? Governments, she warns, are hemmed in by high debt loads and low tax receipts, barely able to fund their bloated systems. And don't even start on tackling that debt, cutting back pensions and welfare. Yeah, that's going to go over real well with the voting public. The reality is, no one's too keen to broach these hard conversations, leaving us in this cycle of indecision and debt-laden stagnation. Now, let's zoom in on some specific players. The United States, for example, still acts like a beacon because its indicators of real economic activity remain decent. Yet, this high gear comes bundled with dismal confidence levels, lurking just below the surface. It's like a shiny sports car that revs its engines but won't get out of the driveway. Confidence is killing momentum. And why wouldn't it? When the Fed can't stop arguing about interest rates and who's going to give another rate hike speech, well, it's no wonder investors are cautious. Meanwhile, China, arguably the industrial motor of the world, is heating up as well. But here's where the fun begins, if you're a fan of roller coasters. Their real indicators are on the rise, yet beneath the sleek veneer, businesses harbor deep worries about long-term sustainability. After years of lockdowns, and a housing sector imploding like bad feng shui, Chinese citizens and investors are asking, so what's next? Another wave of regulations that crack down on our companies, or perhaps a foreign relations incident to derail our tenuous recovery? Jump across the seas to Europe, oh poor Germany, the growth engine of Europe, which saw its last major upswing about when flip phones were still cool. The German economy is officially in its first 2-year consecutive recession in over 2 decades. They might have invented efficiency, but they sure can't seem to apply it to sorting out their ongoing economic woes. With its confidence levels scraping the bottom of the barrel, even die-hard industrialists are wondering if Germany's high-tax, high-spending model has permanently run out of gas. What we're seeing, and which the Brookings FT Tiger Index so elegantly highlights, is that traditional economic concepts no longer tell the whole story. Recovery might mean growing GDP, but it doesn't exactly spell out well-being for the average household caught between life on credit and increasing food prices. Let's not even begin with inflated energy prices after European governments clumsily tried to transition away from fossil fuels right into an undersupplied electric grid. In their rush to embrace green ideals sans adaptation, energy consumption has become an economic liability. Businesses are spooked, some retreating from heavy industries altogether. And, as households try to cope, the spiral into debt follows quickly. Achieving green policies without triggering a fresh recession, anyone? Easier said than done. The more sobering realization here, no matter how fancy economists like the IMF or central banks across the globe try to spin their projections, we're staring down protracted low-growth scenarios. People sense it, hence, confidence collapses under the weight of dim long-term prospects. Investors hesitate, workers clutch their insecurities, and economic systems inch along in paradoxical growth. What might actually be done to break this cycle of low confidence and poorly orchestrated recoveries? 1. Building consistent policy environments. Governments need to stop acting like they're forced to draw policies out of a hat every few months. Stable environments breed confidence, businesses hate guessing games. Consistency in tax and trade rules goes a long way. 2. Resolving political and geopolitical tensions. Fix instability at the root. Easier said than done, yes, but serious diplomatic efforts are vital. Whether it's Middle East turmoil or the Russia-Ukraine saga, markets need predictable boundaries and fewer destabilizing factors. 3. Debt management as a priority. Flashy infrastructure projects are fine for populist rallies, but public debt ballooning without careful planning will sink economies further and make tomorrow's collapse inevitable. How about cutting out unnecessary costs and reorganizing public spending? And there you have it, folks, a masterclass on how today's economic environment, weighed down by declining business confidence, debt burdens, and reckless political agendas, is keeping global recovery well out of reach. Policies that drive governments to patch up short-term problems with quick fixes are making things 10 times worse for long-term futures. So, are we stuck in this quagmire of stagnating confidence and lukewarm growth forever? If governments don't get their act together, it certainly looks like it. The real tragedy is that it doesn't have to be this way. We've shoveled ourselves into a corner, and now we're too busy kicking the can down the road to figure out how to climb out. Once confidence returns, growth will follow. But until then, hold on tight. There just might be more bumps on this economic roller coaster yet.